What is up, YouTube? What is up, guys? The Composer Trader here, and welcome back to another post-trading analysis video. And today we're going to be talking about one specific setup only that we took last Friday in the TCT trading Discord on UNI USDT. And funny enough, this trade was actually brought to my attention by another TCT member. And it just goes to show you how effective having a big trading group can be, because you literally have all eyes on all assets and all trading pairs, which is absolutely amazing. Because you guys know I don't trade UNI USDT, right? So this setup, I'm only taking it because someone brought it to my attention, and then I checked it out and we executed it. So this setup was shared in advance in the VIP trading Discord. You can see right here, we posted this setup in advance, talking about having a short coming into that 12-hour order block, which is something we're going to get into later. And right there, we got filled and price is now currently moving in our desired direction. So I don't think a lot of people notice how much work and how much context building actually goes on behind the scenes before I make a trade setup like that. And that is exactly where these post-trading analysis videos are perfect for. Okay, so you guys can actually learn, study, and find those trading setups yourself. So let's just dive straight into the chart. And most importantly, let's start off with building some context. So we got the macro time frame here on UNI USDT, and we can clearly see that price is trending down right here. Applying the 6-candle rule on the weekly time frame, we can see that we're making lower highs and lower lows. And from there, price did nothing but created a massive range that never swept its initial range low. So we had our initial range low right here, initial range high, and we never had a proper macro accumulation model because price never swept that low. And because price never swept that low, our market structure high stayed the same the entire time. So what we can see right here is that we have a very clear defined range. Price moved up, trying to break that market structure high. And even though we did have a close above it, the next candle immediately closed right below very aggressively, making this a very bad break of structure and potentially more a deviation of that market structure high than really a proper break. Okay, especially if we identify what does this move or what did this move do. Okay, if it just broke it and it came back down, and it didn't mitigate anything special from a supply or liquidity perspective, it would have been better. Otherwise, we can make the argument that, hey, price moved up this aggressively just to mitigate supply or grab liquidity before coming lower. So if we look on the left exactly where price mitigated something, we can see on the left here, we kind of had this redistribution model. Right here, we had this redistribution model too that left behind structure supply before actually breaking towards the downside. So this was a market maker order block, and that's exactly what price mitigated before actually coming down. So whenever you have very strong supply above and you have an aggressive move coming into that very strong supply, I'm always very careful with calling things a break of structure, because the purpose of the move up could just be to mitigate supply to then just go lower. And what followed is actually what gives us that confirmation of actually calling this a fake break, because right here, price exceeded that high, came in at supply zone, and then came down extremely aggressive. Very, very, very aggressive, basically recovering this entire pump and then more. So what you wanted to see for bullish continuation after the break is having a bounce right from this structure demand POI. Okay, that's what you wanted to see for a bullish continuation. So what you would have in that situation is prices trending down right here. It broke market structure back to bullish right here, and you can already see by the shape of this move down to this move up, it's very extended, it's very wide, making it already worse from a break of structure perspective, looking more like a deviation. But besides that, if you wanted to have bullish continuation, this structure demand that you left behind was the ideal place to bounce for the higher low, for the higher high. And we can immediately see that instead of actually bouncing from that structure demand POI, we always or almost mitigate a demand POI for like 95%. Like we just not swept that demand POI low, but we broke in it very deeply and very aggressively, already showing those first signs of this macro demand POI failing. So from there, we got that move up, and just identifying and just following your most basic market structure rules, you guys know, hey, if this is going to be a break, how do we confirm the higher low for the higher high? So how do we confirm that this is going to be the higher low and price is going to rotate back towards that higher high? Now, in order to confirm that, you have to watch your structure from top to bottom. And when that breaks back to bullish, that confirms that this is going to be the higher low for the higher high. It's combining that level 1 with that level 2 market structure as taught to you in the lecture 1 of the mentorship on YouTube. Okay, so identifying our market structure from top to bottom, you can see right here, we simply have a lower high and a lower low. Okay, let's make that red. And that's going to be our level 2 market structure. So breaking this market structure high will confirm the rotation back towards our main market structure high, and therefore confirming this as our higher low for the higher high. And what we can see is that price failed to break that market structure high, and actually what it did is it came into the supply that was protecting that market structure high, and we formed a TCT Model 1 distribution schematic where we have our range right here. We have our initial range high. We have that initial range low. We got the deviation 1. So let's extend that range high to the deviation high. And then we got the deviation 2. So price truly did not want to break that market structure high. And it actually wanted to continue that downtrend from top to bottom, which is exactly what it did. Okay, that's exactly what it did. Now, from there, we know in a downtrend, we can pull our range from bottom to top. So now that this distribution played out, let's delete that. You know that the main market structure from top to bottom is looking exactly like this. And now this could be our new range where price has had its first deviation of our range low, indicating a potential accumulation schematic in the making. Okay. That's kind of the cards that we have been dealt with. This could be a potential range inside of this macro range. And to confirm this macro range, you can also always pull your volume profile to check how the volume is distributed inside of the range. So if we pull our volume from the starting point of the range to the end, we can see that our volume has a lovely P shape, right? We can see it's very equally distributed with a very concentrated POC, point of control, in the middle of the range right here. So this is just a lovely, well-defined range here with then the deviations at the top right here, okay? So it is valid to use this as a macro range, and then inside of that macro range, we have another range. Always ranges within ranges. Now, let's extend this range low to the deviation low and then see what the setup that we had was all about. Now, checking this macro range and checking also our structure, we can see first, if we look at this range itself, okay, we have a range low. We have a potential sweep of that range low, okay, showing signs of a potential accumulation in the making. However, if you want to confirm an accumulation model, you need to have either a model 2 or a model 1. And when you want to have a model 2, price needs to either grab extreme liquidity or grab and mitigate extreme supply. So, checking where is our extreme liquidity in this range, we can see when we draw our first market structure pool on the high time frame that this is that first market structure low that was created, okay? Making this our extreme liquidity POI. Then when we check our market structure within this range, we can see that our market structure on the high time frame from top to bottom is simply one lower high for the lower low. and we also failed to break that market structure high, grabbing actually the liquidity from that POI, mitigating supply, okay? Showing major signs of weakness in the chart. So in general, from a macro standpoint, we can see that price failed to break our market structure within this local range from top to bottom, actually sweeping all buy side liquidity and then mitigating our 3-day order block, which is almost our extreme supply within this. Not our extreme supply, I take that back. We have an order block there, but which is good looking supply within the range. Then if we look at this macro range and where price is located, when we pull our volume profile, we can see that we are at the volume area high. And the general thesis is that, hey, you deviate the volume area high, you come back inside, right? Deviate the volume area low, come back inside, deviate the low, come back inside, flip the POC, come to the volume area high. It kind of is your retail range. So we're kind of deviating that high. So a rotation down towards the low is most likely definitely possible, right? That's definitely possible and definitely on the table. So we're in this POI where from a macro scale, we can have a very good rejection. And also on just a high time frame scale like this range, if you want to be bullish on this range, price needs to come down either way to sweep that extreme liquidity, right? So if you get a very good short opportunity in here, you can definitely take that and target potentially even 5.5 is, which is the first POI for major signs of strength regarding a potential accumulation. So if you get a short confirmation here, that's definitely worth taking, okay? And now, I'm already building up the short. If we identify as to how structure and how price behaved coming into that supply POI right here on the left, we can see that we swept all buy side liquidity, mitigated very good looking supply right above, and then following our structure from low to high, we have higher lows and higher highs, just like this, coming into that POI. And when we're trending up, you pull your range from top to bottom, and then you get something like this, where this is your range. You can always check using your deviation limit tool, DL2. Hey, is this a valid deviation right here? You can see we have no candle close above our deviation limit coming back inside. Therefore, this is a valid deviation, and we can use this as our tap 1. And then this is our first tap 2. Let's extend that range high to the deviation high, and then we have that tap 3. Showing signs of a model 1 distribution coming into a crucial area on the chart, okay? Absolutely crucial area on the chart, which is the supply after sweeping all that buy side liquidity. So we have a model 1, okay? We have a lovely model 1, but that's not just it, because this move up didn't really have proper structure on the high time frame. As you can see right here, we had higher lows and higher highs. And to confirm this model 1, you kind of had to break this high time frame structure, which you never broke. You kind of SFP'd it, right? Right here, you kind of SFP'd it. Now, you guys know that there's always the possibility of our model 1s flowing over into a model 2. Now, if this wants to flow over into a proper model 2, you need to sweep again that extreme liquidity or mitigate extreme supply of demand. In this case, supply, because we're talking about a distribution, right? Let's adjust these tabs so they're perfectly. Now, if we check on the high time frame, hey, what is that first market, or what is that extreme liquidity, aka what is that first market structure high created from top to bottom? We can see a high, we can see a low, we can see a lower high, and we can see a lower low. This is that first market structure high that was created following the 6 candle rule, and therefore this is also your extreme liquidity. So if price exceeds that extreme liquidity point and we get signs of weakness, aka a break of structure back to bearish, that can confirm that this could be that potential macro model 1 flowing over into a model 2. And whenever that happens, guys, your distributions tend to have follow through, okay? So Going on a lower time frame after sweeping that extreme liquidity, we can see right here over on the 30-minute, I'm going to skip over these points, but we have a higher low and a higher high, which is your most recent market structure pool, and you broke that back to bearish right here, okay? Now, at this point in time, on the 31st of October, midnight, I wasn't aware of the distribution, okay? I just wasn't watching this pair, wasn't monitoring it, so I wasn't aware. But if I was, this can already be your short confirmation, and you can target all the way down towards the range low for a lovely 7.92 risk to reward, which is absolutely amazing. Okay, that's an absolutely amazing risk to reward. However, I wasn't watching this pair at that point in time. Now, when I was watching the pair, it was on Friday morning. Okay, Friday morning, I was watching this pair and I was identifying this range, and something catches my attention within this range itself, because in order to make our models or our distribution models higher probability models, we can add multiple variables. And all those variables are explained in the private lectures in the TCT trading community, which I again highly suggest you go and check out if you like my style of trading, my style of teaching, and just my concepts in general. But already giving you guys some juice, if I just look at how price action has spent its time within this range, I can see that there's barely any price action in the lower section of this range. Matter of fact, we just deviated a few times in it, and then that's it. All the price action, all the time has been spent in the upper section of the range. So if I pull my volume profile tool, this will confirm that thesis, where all the volume has been spent in the upper section of the range and there's no volume in the lower section. Now, what this means is that you have an inefficient range. As you guys should know now, ranges love to fill inefficiencies, and therefore I wouldn't be surprised that price can have very easy fill down, okay? Because there's nothing here to hold price up because there's no volume, okay? So the range was inefficient. And not only that, at the moment of entry, which is something we're going to get into, I was also checking where could price potentially bounce, okay? Like where could price potentially bounce? And I couldn't really find an answer on that, because what I'm seeing is that we have one low right here, then we have another low, another low, another low, another low, another low, another low, no demand, simply just lows. We have all these lows where each low is a higher low compared to the previous one. And what I'm aiming for with this is showing you the potential liquidity that is resting below all these lows. And then the moment you take that first low, right, that will cause a trigger for price to come down, sweep that second low and that other low and the other low, and then you have a snowball cascade event down of liquidations. So we literally just had liquidity below us in the range, follow with no volume and an inefficient range. Those are the things that make your schematic a high probability trading schematic, right? A high probability distribution trade setup. So we're entering this crucial area on the chart where on a macro scale, we are at that volume area high. We just swept a lot of buy side liquidity. We mitigated extreme supply. We're creating a high time frame distribution where a model 1 is flowing over into the model 2. We got the confirmation. This high time frame distribution itself is a very high probability setup because it has a range inefficiency and a lot of liquidity below. Now we're talking, right? Now we're talking. So as you can see, it also broke higher time frame structure back to bearish right here. And I was at the chart, let's say right around 9 in the morning, okay? Was at the chart around 9 in the morning, and this trade setup and this potential high time frame setup was brought to my attention by another TCT member. So I was checking this and I was like, guys, this can be a very high probability trading schematic. We can see price curving up nicely right here. And I was checking for a potential retest area where price could tap into before going lower. And then this 12-hour order block was brought to my attention, okay? you can see right here, we have this last bullish upwards candle before the expansion away, leaving an inefficiency, leaving this fair value gap, and therefore also making it a valid expansion. Right here, boom, fair value gap. There you go. Making this a valid order block with the inefficiency, again, guys, as taught to you in the mentorship, and scanning through time frames, this was like that proper extreme supply POI that price could tap into before coming down. So this third tap from a Model 2 perspective grabbed all that liquidity, mitigated some sort of wick supply in here, and there was truly no reason for price to exceed that point again, especially if this was going to be a distribution. Price should not exceed that point. And on the 12-hour here, I also had a order block. So I was like, if price taps into this order block, there's absolutely no reason from a liquidity or a supply perspective to go higher. So if we're going to reject from here. And when I zoomed in on the lower time frame, and I'm going to let you in on this little secret here, my thesis got very, very much confirmed. I was very, very confident in this trade actually playing out from this 12-hour order block, because you can see right here, I have this 12-hour order block, okay? But when I go on the lower time frame, what you'll see is that from the moment I pull that order block, the inefficiency still stays right there. You can see right here, this is the start of the order block. On the low time frame, this is still an inefficiency. You can still see this bearish imbalance on the chart, where you have just this local fair value gap here overlapping that higher fair value gap, where your low time frame structure supply also still has that imbalance, just like your high time frame supply zone. It happens all the time that your high time frame order block is just like liquidity on the lower time frame. Let me see. Let's identify this 12-hour block right here. You can see we had this 12-hour block on our chart on the 12-hour. If I go on the lower time frame, you can see that the inefficiency disappears. Right here, you don't have that imbalance or this bullish expansion that leaves that imbalance before going higher, just like we had here, right? It actually just mitigated the block before continuing higher. So this high time frame block didn't have that low time frame inefficiency, and this high time frame block had. And that's just like that little imbalance in the market, that little moment, which can give you those absolute sniper entries, right? Where your low time frame structure supply also has that inefficiency, just like your high time frame structure supply. And guys, this is truly alpha. This is truly a golden nugget that I'm giving you right here. I'm telling you, study those high time frame order blocks that have also low time frame inefficiencies. When you can combine that, man, you're gonna be trading such high probability blocks. And this is something I haven't even told anyone in the mentorship. This is just like something I'm giving you if you're a warrior and you're watching this exact video. So if you're listening to me right now, I want you to comment golden nugget, okay? If you comment golden nugget, I know that you know and that you're a warrior, okay? So study those high time frame blocks with those low time frame inefficiencies. But I was actually traveling this day, okay? I was traveling this day, so I couldn't monitor the chart. So what I did is I set a limit order exactly on that block with my stop loss above the high with a 3% risk, okay? Because this is a TWT schematic, and a TWT schematic is a schematic from the private lectures, where the W simply means winning because it's a very high probability trading schematic. So I took this with a 3% risk, targeting for now this range low, and price tapped in there, and we rejected extremely hard. And that's currently where we are at right now in the chart, okay? That's simply where we are at. Now, if I was monitoring the charts, you could have actually had an even way more refined entry right in that retest POI, okay? Because if I zoom in on that retest POI, you can see that we created yet again another distribution model on the low time frame, okay? So on the low time frame coming into that supply, we had higher lows and higher highs right here with our range low and our range high. And this was around a 5-minute range, okay? And we can see right here, we have our range high, we have a range low, and then we have that deviation 1. The reason why this is not a deviation and a pullback is because the deviation and the pullback doesn't have the 6-candle rule. And when it doesn't have the 6-candle rule, you can just see this as one push up and not a single deviation, second deviation, okay? It's that low time frame schematics going over into high time frame schematics. So we can see our range, we can see that first deviation. From here, we have the 2-candle pullback and the 2-candle expansion. And then we extend that range high to that deviation high. And right here, you can see your TCT Model 1 distribution schematic, where if you go on the low time frame, right here on this pullback is where that break of structure got confirmed, okay? So drawing your structure locally, you have higher lows and higher highs, and then there you have that break of structure. Now, what price actually ended up doing is coming back for the supply that it left behind, confirming also that this Model 1 is flowing over into that Model 2, and then you broke structure yet again back to bearish. So you can see that we actually had kind of the same model on the low time frame as on the macro / high time frame. Now, if I was monitoring the charts, you can see that this break of structure came around 1 hour into New York Open, which is an amazing time to enter a trade. But you could have entered right here with your stop loss above that local tap, and then you could have ran it down a heck of a lot further, or not a heck of a lot further, but a heck of a lot better from a risk to reward perspective. Because if you were to take this trade all the way down with that tight entry, you already had around an 8.3 risk to reward around its lowest point, which is absolutely amazing. Okay, that's absolutely amazing. So that was basically the trade, right? That was basically a very in-depth analysis of the trade that we're currently in. And that's currently still up and running, right? So what we did is just now, we actually took a 10% take profit. So initially my stop loss was measured above this high. Now I moved this stop loss above that retest high because there's absolutely no reason for price to exceed that point again, because there's no supply or liquidity remaining there to be grabbed before then actually coming down. If that happens, I'll rather just re-enter than potentially risk any money on this trade. But we also have the chance that this turns into an accumulation right here, right? You always have a chance that it turns into an accumulation and that this tab just does not get used, and this is never even a void to be filled. Now, do I think that's going to happen? If I look at this chart, I would say no, because, you know, from a macro standpoint, we are just in that deviation of that volume area high, and we have so much liquidity below. So I truly see price just, you know, doing this before coming higher. But at the same time, you know, we're at this point where Bitcoin wants to go into price discovery, and we have these bullish news events coming. So from a macro environment regarding just timing of the cycle and the spot that we're in, you could say that this could potentially become invalidated. But you know, I like to trade the charts, and if I just look at this chart, I'm telling you, my gut feeling is saying maybe tiny pullback and then just complete it, right? And then when we complete it, I think it can easily make its way down to this extreme liquidity point. So the plan for me right now is I'm going to be taking a 75% take profit on that range low with a limit order, and then that last 25% of the existing position still running. I'll just see if I can take it to this 5.5-ish area, or I'll close it once I see price properly reaccumulating here for the 1, the 2, and the 3, right? That's kind of my planning on this trade. Currently, the stop loss is trailed. We took a 10% tiny take profit to de-risk our position. So it's basically a risk-free trade. We currently have a very tiny accumulation going on here on the 1, the 2, the 3, and that's right here is a demand mitigation. So we could be coming up, sweeping some more buy-side liquidity before actually coming down. that's definitely possible, but it's a de-risk trade. It's a risk-free trade, right? So hope you guys learned something from here. Don't remember or don't forget to comment that golden nugget to prove to yourself that you're actually that real warrior. So I know who's actually paying attention, right? I want to know who's paying close attention. So make sure you comment that golden nugget if you know what that golden nugget means. And I'll see all of you in the next post trading analysis video or in the TCT trading Discord community. Love you guys. Peace.